All right, so as I said, this is kind of your graduation class. We're going to have a few things we're going to go through. I know the last week, I appreciate those of you that were able to accommodate the schedule. I hope those of you that were able to pick up and watch and listen will spend and maybe talk a little bit more about some of the things that we covered in chapter 14 and 15. I know there's a lot of content in 13, 14, 15 when you start talking about Schedule C's and Schedule E's, so we're going to spend some time reviewing that. As you look at the syllabus, it talks about the fact that we're going to talk today about healthcare, other taxes, and amended returns. So 16, 17, and 18, the last three chapters. Not a lot of material. Well, there's a lot of content there, as you can see in your textbook, but there's not a lot of material that we need to address, especially when it comes to healthcare. The mandate is gone. The only thing we have to make sure that you understand is how to reconcile the advanced premium tax credit on a tax return. So we'll make sure to cover that in the scenarios that you may run into. Other taxes, we'll talk briefly about. A lot of them were things that kind of fell by the wayside as far as their importance and the number of people that they may impact due to the Tax Cut and Job Act of 2018. And then we'll talk a little bit about amended returns. During the tax season, you may not see a lot of those, but we'll talk about those. And then the last part is kind of an ethics. That's kind of for you to read, talking about your behavior, I guess, if you, for lack of a better term, but your behavior as it comes to practicing before the IRS and different things that come along with that. Okay, so that's kind of what we'll do. I'm going to try to go through that pretty quickly. Then I'd like to open it up for you that are here, and you guys can, let me know what you want me to talk about, if things you want me to go back and review, if you have certain problems from the workbook that you just want to make sure that you understand, what happened in that problem in the workbook. Like I said, we'll have a couple problems we'll do from 16, and we'll talk about those. Not really anything we're going to do in 17 or 18. The amended return is pretty basic. It's just some procedural things on that. Like I said, you will not see a lot of those, unless you have somebody that comes in that something was wrong with the return from last year and you need to make a correction and before you file the current year's return. Okay. All right. So we'll take care of that. 15, as I talked about in chapter 15, let's see here. Where's my, there it is. Okay. In chapter 15, we mainly, talked about rents and royalties. A big thing was rent income, what goes on with that, how to handle that. The big thing that you're going to see is obviously people that own rental income. The one thing that I want to reiterate that I talked about and I really emphasized to my classroom session and we really picked up on from the National Association of Tax Professionals seminar that we went to in October was that, the QBI, the Qualified Business Income Deduction. That is something where somebody can receive 20% off their rental income should they choose to do that. And the big thing is we talked about those circumstances that apply, those three circumstances that we have to make sure that we know are in effect, that when we talk about rental, that, are they truly a rental income property, enterprise? Somebody owning a double and the other half is being rented, not necessarily something that they're in for a rental enterprise, especially if they have a job where they're working W-2 income. If I have somebody that's maybe retired and they live in a double and maybe own another property, then yes, that would be really one of their main sources of income, so they may qualify for that QBI. Like I said, setting somebody up on that QBI deduction, once you check that box for them in 1 year, it's a tattoo. It stays with them for the rest of their life. So, it can impact things back and forth. I know on the final exam, there were some people that, were in the habit of wanting to take that to get that extra. And really what happened is that it hurt them on the return because there was a loss. So you got to be careful, especially if you got somebody that's self-employed and somebody that has a Schedule E, just like we see in our final exam with the Blarneys. And so, as if anybody's noticed, we did stay with the Irish theme. We had the Murphys for our midterm computer, and our final is the Blarneys. Okay, and make sure that you're paying attention to that QBI. It is very important on that. Okay. The other thing with rental is to make sure that you understand, if it's a double, that you're taking half of things. I will give one clue to a lot of people, and I did to everybody. When you get mortgage statements, obviously they are mailed to the residence of the person that owns the rental properties or the double that they live in. But sometimes down at the bottom, it will say that this 1098 that shows mortgage interest and property taxes. Sometimes on that, it will have the property name, okay? So it may apply to a property that is not necessarily the residence of the primary. A lot of people get in the mode, hey, it was mailed to, Mr. Blarney at 123 Main Street. Okay, so I put that on Schedule A for mortgage interest and property tax. Not always the case. Sometimes their home is paid for and they just have mortgages on rental properties that they've purchased. And in that case, you got to make sure that you get it to the right property. So always make sure you pay close attention to those 1098s to make sure that you look at the property address that mortgage and or property tax or homeowner's insurance, if everything's in escrow, that applies to. So you want to make sure that you pay close attention to that. Okay. Rental incomes, anything else? Not really. Talked about some special situations, and we talked a little bit about, if it's a personal use home, you just got to make sure that when somebody talks about a rental, that they are materially participating, that it is truly a rental. It is available 365 days of the year. If you get into a rental that is really somebody just, a vacation, partial rental, just a little bit of time, you got to be very careful and make sure you handle the percentages correctly. It's very important that you distinguish between a true, building, or I should say, or residence that is a rental, and make sure that you keep those separated so that you know which ones deal with a true rental enterprise and which ones would deal with, just renting a vacation home for a couple months. So you got to make sure that you're very careful with that, because you do not want somebody just to say that they have a rental and it's really not truly a rental that is year-round, and all of a sudden they're taking these huge losses to try to offset income on their tax return. 3 years of that and the IRS sees huge losses, and I've gone through audits with several people that are landlords. The IRS is going to question that. Everybody always says, well, what is a red flag? How do I keep from getting that red flag, the infamous red flag from the IRS? One of those things is making sure that, your rentals are handled properly. We talked about the situation on a personal residence. If they rent it less than 15 days, that, there's no real income impact. Okay, we talked about that. So, all right. Royalties, again, don't see a lot of the royalties. Most of them that I see myself are somebody that I have several teachers that have written books, and with the publishing, they have royalties that come off the sale of their books. It talked about mineral rights, oil, coal, things like that. You don't see a lot of that anymore in royalties. Most of the royalties that come from that come out of an investment, like a mutual fund or brokerage account, and they would more often than not see that on the K-1. So you'd handle that through the K-1 side of the Schedule E, not page 2 of the K-1, as opposed to page 1 with the rental or the royalties there, where you choose that type and put it in those 3 columns, the A, B, and C. Okay. The other one too is just pay close attention when you're doing rentals as far as that comes to farm. Are you renting land? Some people, have property down in the southern tier that they own, and they may rent it out, and somebody just takes and does the hay. My family has now I don't know how many generations, but we are all part owners of a homestead of 360 acres out in Nebraska, and we get rent checks from that, and basically all we can do is take the property taxes that we pay on it and the insurance that we pay on it against that income, and then it becomes income. So there's nothing else that we can do with it. We can't depreciate it. There's just somebody out there that then farms that land and pays for everything as far as the irrigation, the crops, all that stuff like that. So we just lease it to them. Okay, so you got to make sure you handle that correctly. If somebody's actually materially participating in a farm, obviously then it goes on a Schedule F where we have that farm. Okay, all right, so that's chapter 15. All right, any questions on 15? If anybody wants to throw out anything on the chat, or I guess we have a smaller group this morning because, like I said, a lot of people have wrapped things up with the final. So even if you want to pop your mic off and ask a question about anything, please feel free to. Okay, so we're going to move along to healthcare. Okay, I guess something that a little bit more near and dear to my heart, because that's one of my responsibilities here, besides doing taxes and working with students like yourselves and teaching. I do a lot of the speaking engagements, the public relations type stuff, and I'm also licensed to do the New York State of Health and Medicare, so the marketplace and Medicare. Obviously, in 2014, when the Affordable Care Act was passed, healthcare became a huge part of your taxes, because with that mandate from the federal government, with the passing of the Affordable Care Act, which I know it's an oxymoron, Affordable Care Act, that just ranks right up there with Baby Grand and Jumbo Shrimp as far as the biggest oxymorons that you hear. But the Affordable Care Act came into effect, and it basically put people's health care insurance on their tax return. We've talked about it in earlier chapters, and we talked about W-2s and income. Box 12, we see that DD code, dog DD. That was something that showed what the employer paid to the, paid for the employees' health insurance, what the employer paid. So that was one way for us to see that somebody had health insurance, because the mandate said you have to have minimum essential coverage. You have to have coverage of a certain level, and if you do not have that, you will pay a shared responsibility payment. Okay, you can ask for an exemption, and we'll talk about those. But again, that was part of the tax return, the mandate. People had to have insurance. And since that was the case, a lot of people that did not have insurance had the opportunity to go into these marketplaces. Each state had a marketplace. Each state may, some states chose to create their own marketplace, which New York did. That's where, there's about 4 of us that went out and got certified to be able to do that, because when we're doing somebody's tax return, it was like, well, how do I get insurance? So it was something that Esther had us do, and we were happy to do it and help people out. And, to date, I think we've, there's 4 of us. I think we've done, over 5,000 applications for health insurance, because people have asked those questions when they have health insurance going on. So we'll talk a little bit about that. We'll talk about the exemptions, ways to get rid of the penalty. Really, 18 is the last year for the shared responsibility. It expired, if you will, under the law. So now it's no longer a mandate. So on 2019, 19 was the first tax year that you are not mandated to have insurance. You do not have a penalty if you do not have insurance for 2019 and going forward. There is still the marketplace where people can receive the advanced premium tax credit or the premium tax credit to help pay for their health insurance. So we're going to talk about how to reconcile that. That's one of the things that, right after the tax season, and as people right now are trying to enroll, re-enroll, or renew, recertify, whatever you want to call it, for 2020, if they did not handle their advanced premium tax credit correctly on their 2018 return, they will be denied that credit for 2020, okay? Just like Medicare, they look at things 2 years removed. The marketplace does the same thing. When they're looking at 2020's health enrollment, they're looking at 18 tax returns. So there's always that lag time between the two. As a side note, the other thing that's out right now that we do a lot of is IRMA. It's a penalty on Medicare Part B and C that comes into play. And right now for 2020, the IRMA penalty for people is based off their 2018 tax return. What the IRMA penalty is, it's a penalty on your Part B and Part D premium that you pay to be part of Medicare and be able to enroll in Advantage or a supplement or whatever you choose to do to have your health care once you've reached the age of 65. But this IRMA, if your income as an individual goes above $85,000, that's modified adjusted gross income, or as a couple, $170,000, modified adjusted gross income. If it goes above that, then you start to incur a penalty, okay? As an example, I have an individual that I'm helping with. She has solely Social Security. She did get an inheritance, but her main source of income was Social Security of about $25,000 a year, plus she had a small pension. So her modified adjusted gross income was below $40,000, okay? However, on the inheritance, she had decided to spend a lot of time at the casino, okay? She had gross winnings of $250,000, okay? She obviously spent a lot of time at the casino in 2018, okay? That means that the number that the Medicare was looking at through Social Security was at that $40,000 plus that $250,000, $290,000. So that means that her Part B premium went from $144.60 up to $489 a month, okay? That was her penalty, all right? So, you know, even though she didn't have that money, because as we know by gambling winnings, most of the time they have losses to offset it, but in the case of the IRMA, they don't care about the losses. They're only looking at that modified adjusted gross income. So we're fighting it right now. Basically what you can do to fight it is say, hey, you know, that was not a typical year. Here's my 19 projected income and my 20 projected. As I told her, thank goodness she was not able to go to the casino for about 6 or 7 months because she was hospitalized, had some surgery and home recovering. So it kept us well below the 85,000, and we were able to fight, and when we got her IRMA rolled back to the normal Part B premium. But it's just one of those things that comes into play. This is the case where she nope, she can't income average over the 5 years on an amended return, okay? Not with the gambling losses like that. It's just one of those things that the IRS looks at 2 years removed. Another one that we're working on to kind of tell you how it's working. We had a gentleman came in to see us, and his wife had just passed back in September. He was doing some things, changing accounts around for his wife, you know, things that she had that he was the beneficiary on. And one thing that his financial advisor had told him is that he needed to make the conversion of one of these from a traditional to a Roth to try to balance out his portfolio. Well, that's great, but it was pretty sizable, okay? So if he did that all in 19, and the amount he was talking about, he was going to be looking at an IRMA penalty in 2021 where it would have almost tripled his Part B, okay? We were able to do the math and with the conversions and things like that, say, hey, you know, if you break it up this way and try to do a little this year, a little next year, then it's different. Then you're not going to get hit in 2021, okay? So there's a lot of things that play into this. And not only does this IRMA or this excess modified adjusted gross income when you have a gambler or conversion from a traditional to a Roth impact your Medicare, Some people don't realize same thing happens with their star and their enhanced star. All of a sudden they're disqualified from it and their property taxes. So when I talk about my lady that I'm working with that had her modest less than $40,000, Social Security pension income, and that's it, she really almost was below the filing threshold because her pension was low enough that it did not make any of her Social Security taxable. All of a sudden, too, she lost her enhanced star because her income was too high. Okay, so all of a sudden now she's got this huge burden of a Part B. She's got school taxes that she's lost her enhanced star and for the reduction of her school taxes, and in a year where she really doesn't have the income to pay them. So we were able to fight that and get that reversed for her on both cases. So, okay, all right. So let's get into a little bit of the chapter here on healthcare. As I said, we're going to talk about the Affordable Care Act. Okay. The whole minimum essential coverage and the shared responsibility, again, 2018 going backwards towards 14. If you end up doing a return for those years, you might have somebody come in that says, hey, I haven't filed since. So you may have to do something that, you may be filing, 17, 18, and 19, all three or something like that. So we'll make sure that you understand how that works. The big thing that we're going to cover, though, is how to reconcile this premium tax credit. What the tax credit is the government says based on your modified adjusted gross income, the government will give you money to help pay for your insurance through the marketplace, okay? Important that it's through the marketplace. If somebody has insurance through their employer, they do not qualify for this credit, okay? That's that other credit that we talked about in an earlier chapter, okay? When we talked about people that were displaced workers, or we talked about, people that lost their jobs to foreign countries or whatever, that they could do that credit. That's something that is different through, helping in a credit to pay for employer insurance. This one has nothing to do with employer insurance. This is strictly if they go into the marketplace, okay? So they can get it two ways. They can say, no, thank you, I don't want it throughout the year. I'll just see if I get it at the end of the year. Or they can take it as what they call advanced premium tax credit. That's where they get a monthly amount that is going to the insurance provider, okay? And the insurance provider then reduces their health insurance premium on a monthly basis by the amount of credit that they have. Now, the trick is on this, and this is where sometimes it gets a little hazy, and this is where we really come in handy, as opposed to even dealing directly with the New York State of Health Marketplace, is it's always based on projected income. So right now, what I'm doing, if you will, a little bit of crystal ball, is I'm helping people kind of project their income for 2020 to say, okay, this is what my income is, and then the government says, here's what we think that your tax credit's going to be to help you pay for health insurance, okay? So we'll get that. And then the thing is, at the end of the year, we have to reconcile it, okay? So as we guessed at the beginning, at the end. So right now, we're getting ready for people to file their 2020 taxes, 2019 taxes in 2020. Obviously, we're having to make sure that they were close, because if they got too much, they're going to be paying it back. If they didn't get enough, they'll get some extra in their refund, okay? As evidence about paying it back, we're working with somebody that's one of our clients from Florida. Down there, the marketplace is very weak, if you will. We're very lucky in New York that we have several insurance companies in each county that can provide insurance. Down in Florida, it's very weak. A couple moved down there, got insurance through the marketplace. Silver plan, which is very middle of the road. That insurance was going to cost them for a couple $2,400 a month through the marketplace. However, they were receiving $2,100 a month advanced premium tax credit based on the calculations down there. So basically what I'm saying is their insurance was really going to cost them $300 a month. However, they called in October. They had gotten a death benefit as a beneficiary from a family member. It put their income above a certain level. Now they were going to have to pay all of that advanced premium tax credit back because their income went above 400% of the federal poverty level. We'll see that when we get into the 8962. That being said, we immediately talk to them and says, okay, here's what we need to do before the end of the year. Okay, so they were looking at paying back, $24,000 worth of advanced premium tax credit, which, with the inheritance, they basically were going to wipe themselves out. But what we were able to do is they had rentals. We did some things with the rentals, had them invest in the rentals and a couple other things. We were able to roll back their income below the 400%. Then that repayment was capped at $2,500. So now all of a sudden, instead of paying $24,000 back, they're only going to have to pay $2,500 back. So we, save them. But again, that's because we know, and what we're talking with you today about, we know how to make sure that we take and do the taxes right and understand how a tax return works. When you talk to these marketplaces, and trust me, I know from thousands of them that I've done, is that they have no idea what they're talking about at the marketplace. In fact, they will be the first to admit. I've had people on the call center that I have for navigators, and they'll say something. I said, no, that's wrong. That's not the way a tax return works. And they go, well, we don't give tax advice. And I said, good thing, because that was the wrong thing to say. So, a lot of people come to us because we know the ins and outs of the tax return, so we can keep their health insurance costs down or repayment of their advanced premium tax credit. Okay. All right. Minimum essential coverage. Again, you're not going to see a lot of this with the minimum essential coverage because, again, it stopped in 18. Basically, minimum essential coverage is having insurance for 1 day of a month, and all that insurance has to cover is hospitalization. So an example, Part A is the hospital coverage for Medicare. Okay. If that's all you have, you meet a minimum essential coverage as long as you had that in a month for 1 day. Okay. So that's the minimum essential coverage. All right. Talks about types of minimum essential coverage here that you see on this page. A lot of times, especially with our proximity, we have people that will ask, hey, I'm covered in Canada. Does that work? Yes, it does. Okay. They have minimum essential coverage and being covered in a foreign country. Okay. But it just has to meet that hospitalization coverage, if you will. Okay. All right. Okay. Now, exemptions. When somebody does not have insurance, there's several ways to get exemptions from the penalty. Okay. We can do what's called a marketplace granted coverage exemption. All right. Basically what that is that's where you ask for forgiveness because, hey, I had a hardship. Okay. Believe it or not, the hardship has 14 categories. It's a separate form. Again, I'll show you on the 8965 when we get into a problem how to handle it. But if you're asking for it on a general basis from the marketplace, that's where you're asking, the national, federal, or whatever you want to call it, for forgiveness. Here's a form you fill out. They'll be available in the offices as part of our forms folder that we do on the computer, every desktop. But there's 14. First 13, some of them are in there. You had a shutoff notice. You forgot to pay your electric bill. Okay. If you have a shutoff notice and says that you didn't pay your electric bill, that can be an exemption. You had to take time off work to take care of a sick relative. That keeps you from having to pay the shared responsibility. Okay. So there's 13 of them and varying different things. Some of them could even say, hey, I'm a member of a religious group that says I should not have health insurance and should not have health care. That works too. But number 14 is some other extenuating circumstances. So basically 14.1 on this form is saying, hey, make one up. And if we like it, we'll let you have it. So there's a lot of exemptions to keep from the shared responsibility. The other one is in Part 2 of the 8965, you have where you can have, because your filing threshold is below, or your income is below the filing threshold. That puts you on exemption because it says you can't afford it. But if your income's that low, chances are you're going to be on Medicaid, so you have free insurance. Okay. The last section is basically something that is granted on the tax return for somebody. Most commonly, we use a couple different ones. We use the unaffordable. We say that whatever somebody would have to pay is greater than 8% of their modified adjusted gross income, or they had a short-term gap. Say they changed jobs and they had that 60 or 90-day waiting period before the insurance would kick in. If they had that case, then we can do a short-term exemption for 3 months or less. Okay, so that's where we have those two. All right, so those are the most common ones we use on exemptions. And again, when we get into a problem, we'll take a look at that. Okay, as far as the calculating of these premium tax credits and these exemptions and stuff, it's based on a tax return. So it's based on the household income for the tax family or the tax household, okay? So if it's myself, my wife, and my daughter on the tax return, for the sake of health insurance, that is our tax household or tax family. That's where all of these calculations and all these rules apply. Even though under my roof, under my house, I have my mother and 2 other children living with me, okay? Even though there's 6 of us in the house, that does not matter for the calculation, okay? Whether it be the advanced premium tax credit or the shared responsibility. It only draws from your tax household, okay? So this is one of the few unique times, though, that if it's myself, my wife, and my daughter is of age to work, her income is counted towards my calculation, both for my exemptions and my advanced premium tax credit. Her income does not affect my taxable income or my gross income for my tax return, but we do put that dependence income in there, because in the marketplace, when you apply for anybody that is part of the tax household, you do have to turn in their income. Now, it doesn't matter about the other 3 people that are living with us. Theirs doesn't matter, okay? So that's where we have to make sure we understand that's how the calculation works. Proof of the health coverage is really from these 3 forms, 1095A, 1095B, 1095C. 1095A is insurance from the marketplace, okay? That means that we got insurance, and typically it would be a metal type 1. I'm talking about bronze, silver, gold, and platinum, so the metal levels. And according to my application to the marketplace, I was getting $200 a month to help pay for my health insurance. I would receive a 1095A and then put that on my tax return on the form 8962. Again, we'll be talking, I'll show you how to do all these, but that's where I would reconcile it. Now, if I go to the marketplace and I get the essential plan, which is $20 a month, or I get put on Medicaid, okay, then those 2, I got insurance from the marketplace, but I would not receive a 1095A. All I would receive is a 1095B that says I was covered, and it would show the number of months that I was covered. 1095C is something somebody would get from an employer. Besides the DD code that we saw in box 12, you would also see 1095C, and it would show, hey, John Smith was offered insurance from his employer, it met minimum essential coverage, and here's the months that he took it. Okay, so it's another way for you to see that they had health insurance. Okay. The premium tax credit, it is great as long as it's done correctly. Okay. What I mean by that, you got to be diligent on that projection of income, because like I said, if you're off, they could end up paying a whole bunch back at the end of the year. And the one thing about the marketplace is they want you to do, come into them within 60 days of a change of income. So, that's what this couple, and thank goodness that they called us in Florida to say, hey, our income's changing because of this, death benefit that we received from an IRA as a beneficiary. So here's what's going to happen. So we were able to make the correction before the end of the calendar year. That's probably not something that we were going to be able to do after the first of the year with the strategy that we had to employ. Okay. It wasn't as simple as putting money in an IRA, because with the beneficiary death benefit, their income went too high and it phased out a lot of things that we could do on the tax return. But we could do some things, like I said, on the rental property where they were able to invest in some things and buy some things, and the way we handled depreciation. Remember, I talked about special depreciation in Section 179, using it to kind of, if you will, we'll say massage the numbers to help us out. How we take it when we take our depreciation, we were able to do some things with that. Okay. We talked about the coverage family. Like I said, everything is based on the federal poverty level. okay? Nationally, Medicaid's threshold is 100% of the federal poverty level. We live in a state that has decided to do expanded under the law. They can do that. And Medicaid threshold, where you would no longer qualify for Medicaid, is 138% of the federal poverty level. Okay, so give or take, it's going just right around $17,000 now for 2020 is that threshold. Okay, the 400% federal poverty level, that's where the cap is. You know, once you're above 400% of the federal poverty level, you are no longer eligible for the premium tax or advanced premium tax credit. Okay, so basically the wheelhouse for this whole healthcare thing in the state of New York is between 138% and 400% of the federal poverty level. And as you can see, it depends again on your family size. Okay. All right. 1095A, we'll talk more about that. It's really driven by these three columns. As you can see in the middle column B, the premium tax credit and repayment, how much you pay and stuff like that. Oddly enough, and I don't know how they did this, nobody's ever been able to explain this to me, but they calculate everything off the second lowest cost silver plan, okay? So if I have Fidelis come in at one level, and then the second lowest cost is independent health, well, all the premium tax credits are based off that independent health, okay? The second lowest cost silver. That's why I say down in Florida, where this couple was at, they lived in Lee and Collier County area down in Fort Myers. They had one insurance company, Blue Cross Blue Shield, and their second lowest cost silver plan was huge, okay, over $2,000. So that's where that premium tax credit would be calculated off of, okay? Let's see here. That's just some calculations that they're doing. This is kind of, you know, if you want to see a 1095A, again, we're going to talk about it when we do one of the problems here in a second. But, you know, this is kind of one of the 1095As in action here. You can see, you know, monthly premiums, second lowest cost silver, advanced premium tax credit, you know, that's based on what they put into the marketplace as their income that they got to help pay for health insurance, okay? We'll show a little bit more of this 8962 when we get into the problem that we're going to work on, okay? A couple problems there that you go through. Let's see here. We'll talk about the 8965 again when we get into the problems there in the chapter, okay? All right. So that's it for that chapter. Real quick on chapter 17. This is a chapter that just kind of got dumped in there to say, hey, you know, here's some other taxes that we have. Alternative minimum tax was more prevalent 2018 back. With the Tax Cut and Job Act of 2017, alternative minimum tax, the thresholds and how it's calculated almost became non-existent on 98% of tax returns. So the alternative minimum tax is kind of disappeared. Kiddie tax is disappearing because people are realizing that it has become a little bit more, you know, it's a little bit more detrimental. It used to be that if grandma and grandpa bought a, you know, an account, an investment account for their grandson or daughter to go to college, and then when they went to college, they started to cash in and sell this. And if they had over $2,100 of investment income, you know, from cashing in bonds or selling stock or whatever, then you had to do a kiddie tax. What a kiddie tax was is that investment income would more than likely be taxed at their parents' tax rate as opposed to their tax rate. The new Tax Cut and Job Act actually made the kiddie tax a little bit more aggressive as far as the percentage, and so a lot of people have converted out of that type of funding for college and have chosen to go into the 529s. You know, the college funds that you can put money in that you do get a reduction on your tax that you put on the tax return. So the kiddie tax, again, very involved, but, you know, most of the time you have to do two scenarios, kind of the kids, if they have some, you know, working at Tim Hortons and have extra income versus that tax being taxed at their parents' tax rate. And then actually, believe it or not, the child doesn't file a return, they end up kind of piggybacking, and that investment income through the kiddie tax is put on mom and dad's. Again, right now, 19 going forward, you're just not going to see it because it, a lot of people have understood, and investment people with funding for college have understood that this is, really detrimental to the return on those type of things, and people are, jumping ship with that type of college funding and going back to the 529s. Okay, we talked about unreported Social Security and Medicare tax, household employment tax. We talked a little bit about. That one really is where you have somebody that you are hired that is really truly a household employee. You do that Schedule H, because basically you have to do your payroll taxes on your tax return. So if I have, my wife and I, when we're older, we decide that, my wife hires somebody to take care of me, while she's at work, and they're there from 9 to noon, Monday through Friday. I tell them when to be there. They have specific responsibilities and things they have to do. That's an employee, and I have to really pay them such, and I would have to do a household employment tax, a Schedule H. Okay. First-time home buyer credit. Again, it's this is probably one of the worst tax laws that anybody ever wrote. Okay, and they knew it, and about 11 months later, and changed it. There's about 11 or 12-month window that people that got this credit, roughly $8,000, had to pay it back. $250 per person, $500 per couple on their tax returns. So it was a repayment of a credit they received, and then on each tax return afterwards, they had to pay that back until they either paid it off or sold the house that it applied to. Then all of a sudden they decided, well, that's dumb. Why are we having to pay it back? And that's not helping. And then so there's certain people that 1 month they're paying this thing back, and if they bought the house 30 days later, they didn't have to pay it back. Okay, so they not only do they create a problem with the whole paying it back thing, but they also create a problem by somebody saying, oops, you should have waited 30 days to close on the house, then you wouldn't have to pay that credit back. So, but it's something on the return you have to make sure that you ask about, because it's one of those things. There's so few cases of people paying it back, and they forget about it because it automatically, kind of carries forward. And if you don't get it done right, it can delay their refund, and then the IRS just creates a headache for you. So make sure that you pay close attention to that first-time home buyer credit. Okay. Additional Medicare tax should have really been in the last chapter with healthcare. Really what that is kind of a residual from the Affordable Care Act. It's a tax that when your income is above a certain level, you get an extra tax to help fund the Affordable Care Act. So for those in the top 1%, they're paying a tax on their income that's going back into the system to help subsidize the Affordable Care Act and the advanced premium tax credits. Okay. All right, so that's really chapter 17. Okay. Chapter 18 talks about amended returns, ethics, and practicing before the IRS. Amended returns we're going to talk about in there when we get into a couple of returns. Like I said, we're going to do a couple problems today that'll deal with the Affordable Care Act and amending things, and then I'm going to open it up to you guys for any questions you have or anything you want me to go back and take a look at and review. But the big thing about amended returns is really you have to make sure you procedurally handle them correctly, okay? Most often during the tax season, the amended returns you're going to see are those ones where, somebody's college student beat them to the finish line, filed before mom and dad, and didn't handle it right, and didn't say they were dependent on somebody else's, cost mom and dad a whole bunch of money. So then we have to amend junior's return, and, mom and dad's, if it's already filed, amend it too, because they created a conflict, and send them in paper, and it delays, the refunds in both cases weeks. So, it's where you cannot emphasize enough that if somebody has a college student, say, hey, you need to talk to your college student, make sure they understand that you file first because of the American Opportunity Credit for that undergraduate. That credit is not going to help the college student. It just, they don't make enough money, all right? And, with their age and stuff like that, there's restrictions on that credit. So you have to make sure they understand that so that they file it correctly, okay? As far as third-party authorization, When you are doing returns for EG Tax, Esther and EG Tax Service Incorporated is the third party. You are the preparer, and as it says, you're a tax preparer. Once you get set up with us, we'll get you set up with your PETN. That's your kind of ID number. It's something that they started to do because it used to be that tax preparers put their social security number on the bottom of a tax return as their ID, which obviously in this day and age of identity theft, not a good idea, okay? You don't want your social security number floating around out there. So they did the PETN system. New York did the same thing. You get credentials, you get a PETN number. The IRS, several things have gone to court just to be a registered tax preparer. You do not have to do CE, but for the state of New York, you do. The next level after being a registered tax preparer is that you can be a registered tax professional. You do some certain amount of hours. That way you can talk to the IRS on different levels. And then the final level that we have here is that we teach the EA class. That's called an enrolled agent. An enrolled agent is basically one step below a tax attorney. They can represent somebody in an audit with the IRS, arguing with the IRS, talking to the IRS, right up to the point where they go through the doors and stand in front of a judge. 99% of audits never get in front of a judge unless somebody really wants to fight it. So most of the time our enrolled agents that are here either through an offer and compromise or an audit with one of the local IRS agents, they would handle it long before it ever gets to that stage, okay? As far as tax preparer and tax preparer responsibilities, I'm going to allow you just to read those, just have knowledge of them. Obviously, the biggest thing is do not commit fraud, okay? And one of the greatest areas of fraud is not doing your due diligence on the earned income credit or additional child tax credit or any refundable credit where you're giving them money. It's not like the non-refundable where that's basically seeing how much of their withholding or the tax they paid throughout the year we can get back. Those refundable credits are the ones that they like to crack down on. Those are the ones that are that found money, if you will, on the return. Earned income credit, American Opportunity, additional child tax credit, credits that we get no matter whether we have a tax bill or not or had withholding or not, okay? So those are the big ones that you just have to make sure that you understand, okay? All right, any questions on those? I know we just kind of whipped through 4 chapters real quick, but like I said, I'd like to spend a little more time today since this is kind of our graduation class to work on some problems. We're going to do a problem for healthcare. We'll do it a little amended, and if there's any other ones that you guys want me to go back and take a look at or certain topics, we'll try to find some returns that we can work on some subjects on that matter, okay? All right. So is there any questions at this time? All right, got a quiet group this morning, okay? All right, so no questions there. Let's see, well, it's almost 10 o'clock. We're gonna say that we'll be back at, let's see here, let's do 10:10. All right, so we're gonna take a short break. We'll be back together at 10:10. What I'm going to do is, like I said, I'm going to do one of the problems regarding healthcare so I can show you how to make sure you get that 1095A and the 8962 handled correctly. And then, like I said, I'm going to kind of open it up to you guys. So if you want to take a look back through the workbook, you know, especially problems from chapter 13, 14, 15, where we dealt with, you know, more involved stuff with the Schedule C or Schedule E and amended returns, or excuse me, depreciation. We can talk about those. And like I said, just kind of open up the subjects. And no, I did this for my classroom sessions. I am not going to cover the final exam, what is on it. I gave you guys some hints on the topics for it, but we won't be doing that. And like I said, for those of you that have chosen to work for us, you know, make sure that you get scheduled for your final exam to come into the corporate office and take it. It's always nice for me because sometimes I actually get to see faces and meet all these people I've been talking to for several weeks and really months, and you know, get a chance to see them and see what they do. And it's great for me because I get to see what they've done in the computer. It's always very hard for me to know what they've done and how they've done things, because I'm just looking at a PDF of all these returns and knowing what everybody's doing there. Okay. So, with that, and then do you want to work forms? We'd love to have everybody work for us. I know sometimes circumstances, stuff like that, going through the class, if anybody wants to work for us. And even after doing the class this year, but because of circumstances, things didn't quite work out, going ahead and taking the final exam. Even if you can't make it in, I can send it to you. We'll get you through the class, get your CE, get your certificate that we send, and then we can, hopefully things will work out that you can come back next year. Doesn't mean necessarily you have to take the class over, depending on how things do, but, opportunity you can come back and meet with us and do things for next year. Okay. All right. So like I said, 10-10, we'll be back. We're going to do a problem on healthcare. We'll talk a little bit about amended returns and handling that. And then, check your workbook, check your problems, anything you guys want to take a look at. Okay. So see everybody in about 10 minutes. Okay, everybody. We're back. Like I said, what we're going to do, we're going to start out just doing one of the healthcare problems, so I can kind of make sure you understand how that 8962 works. And then should you have to do a previous year's return, talking about how the exemption 8965 would work for you also. Okay, so we're going to talk about those two. All right, and then I had a request already for talking about problem 15.2. It's about the prior year's depreciation. We'll talk about that, calculating that. So we'll go through that. I think I can figure out a way without having a dry erase board. I'll see if I can figure out a way to kind of go through that with everybody with prior depreciation. And we'll talk about that one too. Okay. All right, so what we're going to do is I am going to take a look, and I want you in your workbook, we're going to do problem 16.3. It's on page 16.7 in your workbook. What we're doing when we do these healthcare ones, we're just using previous returns we've done. In this case, we're using Rob and Susanna Simpson, okay? So I went ahead and brought their return up on the return, or excuse me, on the tax-wise. If we can remember, they are a couple. Move myself out of the way here. They are a couple, married filing joint, no dependents. Okay, so in this problem, talks about that rather than receiving health care insurance through Rob's employer, Rob and Susanna obtained their insurance through the New York State of Health Marketplace. They elected to accept the advanced premium tax credit. They canceled their insurance as of November 1st, believing they had a better option. However, that did not pan out. As far as open enrollment, like I said, tomorrow is the last day, so I have a busy afternoon, but open enrollment is right now if you're going to apply for what they call Qualified Health Plan, QHP. That would be something that is a bronze, silver, gold, or platinum, or if you're under the age of 30, catastrophic, okay? If you qualify for Medicaid, or what they now call managed care, or you qualify for the essential plan, which is the $20 a month insurance, that would be something that has open enrollment year-round. The way the marketplace works is the insurance, well, unless you have special enrollment, which I'll talk about in just a second, but the way the marketplace works is the insurance has to be applied for within, by the 15th of a month to be effective for the 1st of the next month. So obviously, right now, December 15th for January 1st. Same thing applies with open enrollment year-round for the managed care or the essential plan. The other thing that comes into play, like I said, is special enrollment time. So if you lose insurance from your employer, you get married, you have a baby, something that is called a life-changing event, then you would be eligible, dramatic change in income where you can't afford the insurance you have. That means you would be able to go into the marketplace throughout the year at any point, and again, use that 15th of a month for the effective of the 1st of the next month. Okay. So they took and got the advanced premium tax credit for 2018. So they have, as you see on page 16.8, they have a 1095A. Okay. So the way this works is we have to go back to their ACA worksheet. Okay. And on their ACA worksheet, page 1, okay. So on their ACA worksheet, page 1, previously they had employer insurance, so we had no on the marketplace and no for an exemption, and they were covered. Okay, but now we're going to use this scenario that we have for this problem. All right. I've kind of skipped over this, said we always come back to it. Here we are, time to come back to it. Okay. Did the taxpayer, spouse, or any dependent receive insurance through the marketplace? All right. Again, they could say to you, they could have a 1095B and say to you, yes, we got it through the marketplace. If they have a 1095B, that means that they have managed care, Medicaid, or they have essential plan. We're still going to check no here. Okay, I know it's a little quirk, but we're still going to check no. If they have an insurance policy where they got an advanced premium tax credit, like the 1095A that we see for Rob and Susanna, okay, that's where you're going to check yes, okay, because what that does is it generates the form 8962. All right, so when we do that 8962, if we take a look, all right, it generates down here on the tree on the left the 8962, and then when we're going to check yes, the 8965. Okay, so basically what happens is those two forms now have the little red exclamation point says, hey, we need to address them. All right. Now, as far as the 3 boxes behind each of the names, all right, if it were the case that in this scenario we have that we're going to have the marketplace and we have an exemption. So we're going to account, if you will, for all 12 months of the insurance, then there will be no penalty. So we're checking box 1. Okay. If it's a case that they did not qualify for an exemption, you would be checking no. You'd be checking the second box, and then all the months would light up. And we know from looking at the script there that they had no insurance in November or December. Okay. Same thing we're going to say for Susanna. Okay. What that does is it triggers the ACA worksheet page 2. And that's where you can see here with the 2 numbers in the boxes, there's their maximum penalty. So based on the months they have and the way the calculations work, they are going to have a $232 tax penalty. Okay. And you can see it shows up here on Schedule 4, line 61. Okay. So that's if they did not have the exemption. In this case, we're going to do an exemption. So we've accounted for all 12 months. Okay. All right. So the first thing we're going to do is, yes, they had the marketplace. We're going to go address this exemption. All right. As I said, there's really 3 scenarios where you can get an exemption from the shared responsibility. Marketplace. So I'm going to put up here the individual's name, social security number. And if I am doing the hardship, which is really the only one that still exists, and I do the hardship form, and again, that form is available. It's a separate form, doesn't go with the tax return. Actually, it's mailed to somewhere in Lexington, Kentucky. How they ever get them together, I don't know, but we've never had one denied. But so I would put in here, if we're going to do that, I would put Rob's name here, put Susanna's name. All right, put their social securities in, obviously, and the certificate number, I won't know it because it's gone in. Okay, so all I have to do is type in their pending. Oddly enough, it fits in there just perfect. Okay, so we have that. All right, so that's the way we would do it if we were going to do it for a hardship. All right, again, I talked about the hardships being, taking time off work for a sick relative, you know, you had a foreclosure on your house, you couldn't pay the electric bill, you had a shut-off notice, something that is a hardship that did not allow you to get insurance, all right? Part 2 talks about filing threshold and household income. Well, if we look here, the filing threshold for the two of them is $24,000. Again, you know, that standard deduction. And their ACA adjusted gross income is 58. So they do not qualify for this one, all right? However, we're going to come down here to the bottom, and we're going to have Rob, okay? And we'll have his social security number. We're just going to put a fictitious one in there, okay? And then I'm going to have a couple choices here. I'm going to do A, where it was unaffordable, or B, short-term gap. And the way to find those is if I hit F1 and I go into my little help menu, all right, the very bottom it says click here for exemption codes, all right. And again, A is saying that there was greater than 8%. B is a short-term gap. C is somebody living abroad. D is living, somebody that's part of a healthcare sharing ministry, kind of those co-ops that you hear about on the radio, Medicare, okay? E is member of a Indian tribe. F is incarcerated, okay? And G is, again, some unaffordable things with the Medicaid. We could do G for a hardship. And we have H where they, you know, again, based on somebody in the household died during the year, things like that. But again, most common ones you're going to use are A and B, okay? So we have those two, all right? In this case, we have a short-term gap B for the months of November, December. And what this does is it keeps from Rob and Susanna paying for, paying the shared responsibility penalty. So this form would go in with that, okay? So we have that part, all right? Okay, the next section that I have here, next form I have is the 1095A. So I'm going to go to my 8962, all right? This is the form where we reconcile that premium tax or advanced premium tax credit that they got throughout the year. Part 1, again, we see their household size, modified adjusted gross income. Here you can see where it says enter total of your dependents' modified adjusted gross income. Like I talked about, if I had my daughter on my tax return as a dependent and we were in the marketplace, I would have to put her income. It's not going to affect my tax return as far as my taxable income, but it does affect how this reconciliation of the advanced premium tax credit takes place, okay? So we have to kind of do that, all right? Okay, so what we're going to do with it, we don't have to do anything here, but you would enter that number. So if she made $5,000 working at Tim Hortons, I would have to put it in, all right? Household income's in there. Federal poverty line, again, we have to decide. You know, Alaska, Hawaii have different ones. We're part of the 48 states. So we can see here that, you know, there's the federal poverty level, $16,240. Their income, Rob and Susanna's, are 361%. So that says that they should be able to contribute $467 a month towards their health insurance, okay? Part 2, are you allocating? No. If you ever get an allocation, and I'm not even going to really cover it, basically what happens in an allocation is all of a sudden we have a tax return where somebody that was on the on the health insurance ends up filing separate. We have to allocate, or in a year where somebody gets married. So I have one individual comes from an employer plan. I have another individual that's in the marketplace. They get married in June. They both go on to the employer insurance. I then have to do an allocation because of the 6 months that one of the people was on the health insurance. And you know, it becomes a little involved. So, and actually, believe it or not, all of them that are done by EG Tax go through me. So if you get one of those where you have an allocation, you send them my way, all right? Box 10 basically is asking, what does my 1095A look like? do I have a 1095A where all 12 months are filled in? If I look at the Part 3 on my 1095A, I do not. Remember, we just addressed November and December. Okay? So if I said yes, then here in line 11, I could just put the column totals. I have to do a no, so that's going to make it red down at the bottom. Okay? Now, this part gets a little confusing for a lot of people because, you know, your 1095A has columns A, B, and C. Okay? On here, we have A, B, C, D, E, F. All right? So basically what I'm saying is that we have to make sure that we understand that the ABC that is on the 1095A is not the same ABC that is on our 8962. Okay? If you look down at the bottom of the column A, or excuse me, at the A there, it says Form 1095A, lines 21 through 32, column A, column B, and then over on F, it says column C, okay? In other words, these, where I can enter numbers, these other ones are yellow. They're calculated, so I can't do anything with them, all right? So basically what we have here is we recreate this, 703.28, okay? Column B is 590.03. It's the second lowest cost silver. If you ever need those, we have things in the offices, again, in office forms where you can look those up. 425 is the last one, okay? All right, so we have those. Now, sorry to say tax-wise is kind of DOS-based, so it's not Windows-friendly where you can right-click and copy. So you got to use the old-fashioned Control-C, and then you got to use the Control-V to paste into each one of those. So we'll do that through October, okay? Same thing for this one. Oops. Okay, and same thing for the last column here. Okay, oops, got one extra one in there. Okay, all right, so now to address a little bit, remember what the scenario said? They canceled their insurance. Well, prior to the beginning of the month, when the bill's due, the government will send the insurance company the credit based on what this person is entitled to. So in the case of November, Rob and Susanna had $425 sent to the insurance company on their behalf, even though they did not make the premium tax, or excuse me, the insurance premium payment. So basically what's saying is the government's saying, hey, we gave money to the insurance company on your behalf. We're not asking for it back. We're asking it back from you, okay? So the fact that they did not pay their bill in November, they're responsible for that premium tax credit, okay? So you can see what happened. Now, down at the bottom, all right, if it was the case that, you know, basically what this is showing is because of what my shared responsibility should be, it's saying I should have gotten $123 a month. However, they received $425 a month. So they got an excess, all right? Now, if my premium tax credit is greater than what I received, I would get a net premium tax credit, so that would be there. In this case, what happened is they have repayment because they had an extra $3,445. Now, because their federal poverty level was up here below between 300 and 400%, they only have to pay back $2,600, all right? So there's a cap, all right? But if their income was over the 400%, they would have to pay back that entire amount. That's what I was talking about, that couple in Florida. So, you know, this is done very correct, and you have to make sure that you get that column C in, okay? I realize column C on the 1095A and column F on the 8962. Typical IRS, the only agency in the world where it tells you that C equals F, okay? But that's what you have to do. That is the important part to get in there. Make sure it goes in there. Make sure these 1095As. I cringe at the number of letters that I have to process over the summer. Again, because of my background with the health insurance marketplace and Medicare, I'm the one that has these. I do the IRMAs that we talked about. You know, it's just so important that you get these in there, because in the case of this one, you know, $2,600. All right. If you remember the Simpsons beforehand, they had a, let's see here. If I go to theirs, they had a refund of, let's see, $2,160. Okay. If you look now, they owe $672. All right. So things just got wiped out by the fact they got too much. They got too much help throughout the year. All right. If I took this and I made each one of these 50, okay, so they only got $50 a month. Oop. There we go. Okay, so if they only got $50 a month, okay, including that extra month that they had in there, you could see their refund will go up because I have an extra $680 here. Okay, so you can see how this advanced premium tax credit, if you don't project your income correctly through the marketplace, it can swing things one way or the other. Now, there's some people that says, I don't want to roll the dice. I don't want the advanced premium tax credit. I'll just pay for my insurance and see what comes out at the end, because they don't want this where, you know, because with the Affordable Care Act and this way this reconciliation works, you know, there's some people that really, like we've told you in the past, count on their refund as that extra paycheck to maybe pay off a bill or to pay their property taxes. And all of a sudden they've estimated wrong and their refund is gone, or they maybe owe money. Now they don't have it in their budget. They don't have that income to make those payments. So that's where it's so important that you make sure that anybody that's going in there, you know, if they don't do it right, send them to see me. We'll get it straightened out. You can always correct the income throughout the year. It's not something that's just done once. I'm adjusting people all the time, okay? So just make sure that they get that done correctly, okay? All right. Any questions on that? Any questions on the Affordable Care Act at all? Again, if you want to pop your mics off, you can. All right. Nothing on there. Okay. So we're in good shape there. All right. So what we're going to cover next is, let's see, we had a question on 15.2. Let me go find it in the workbook here. Whoops, that went too far. So that would be something about rental. Okay, so it's that Ziegler return that we did together. Okay. All right, so let me see if I can find the Zieglers. Okay. All right. Okay, so let's see, where's my button? There it is. Okay. All right, so we have Thomas and we have Judith Ziegler. Okay, so this was the return that I'd had a question about. Okay, and we had our refund. The question, let me just make sure here. Okay, so we have, okay. So it's just kind of a question about prior depreciation. All right. So we had, let me get to what we had here, because on this return, oops, hold on. Okay. So on this return, when under our asset type, we had, our 404 Woodlawn Avenue, the building that they had. They purchased the duplex on June 1st. All right. And so we basically, that's what we were using that. So we have prior depreciation to calculate. Okay. So we have a basis, as we can see here. Well, with our basis after we subtract and take half, we have the basis of 36,900. Okay. All right. Give me 1 second here. I'm just working on something. All right. And we started off in 2003. Okay. All right, so we had the years that we were going to do this. All right, and let me see here. A couple things that we'll need. Okay. All right, so we have, right now we have it, and what we're looking to do is figure out this prior depreciation, okay? All right, so we're gonna take and we're gonna do that, okay? So we're gonna be jumping back and forth, so I apologize. Without having a dry erase board, this is the best way I could figure out to do it on the break here. So, all right, so we have, the first thing we have to refer back to is the fact that we're going to use the little table that's in chapter, let's see, it's in 15, right? Yes, 15 on bottom of page 1511 in your book. So having these is going to be handy, but we're going to use this chart to calculate prior depreciation, okay? So we know if we look at the chart, basically what's going to happen with the prior depreciation is that we are going to use the fact that it was purchased and placed in service on June 1st, okay? So for this one, we're going to use this. We're going to use this column because this is the month, June, okay? So we're going to use that column, all right? And what that's going to allow us to do is get the determining of what percentage of the basis each year is going to do. So, okay, and then for tiers 2 through 9, okay, we have that 3.636. Oops, hold on 1 second here. right. So that's years 2 through 9. All right. And then in year 10, we go up to a little bit. And then in year 11, then we kind of alternate back and forth here. Okay, so we have prior depreciation on this. Okay, so basically we're going to use those percentages on that. All right, so let's see here. What I kind of set us up with is basically a little spreadsheet that has their, whoops. Okay, so if you take a look, I got us on a little spreadsheet there basically showing the percentages. Okay, so basically we're going to have it times our basis. So we're going to take this. All right, and we're going to have oh. Okay. All right, so you can see the numbers that we have there. Okay, so in the first year, because it's in the 6th month, we're using a smaller percentage. All right, let me spread this out so we got a little bit. Okay, and then I'm going to have all the years successive after that, basically the years 2 through 9. Like I said, we're using that from that that table that's on the bottom of 1511, and then we get a total down there where we have that 19,511.61. Okay, so that's the way we calculate prior depreciation. All right. Okay, so that means that okay, I will go in here and put that in as our prior depreciation. And the importance of that is because if I go to sell this, I need to have that prior depreciation because, you know, when I'm selling the property, I have to recapture that depreciation whether I took it or not. So you have to make sure that you get it back in there. All right. Okay. And then the second part of that question was, current year was different from the previous years, right? And it's because of a lot of it has to do with the percentage there. So if we take a look at the, this is, that's the roof. The driveway, the number being the current and next year's depreciation. It just depends when it falls in there as far as when we did it. This case, we did it in September. And if you think about the way that table works on in the book, you know, that percentage that we have, that's where that number can work out a little bit different because of that percentage. Okay, so it all depends on what month it's placed into service and how the table works. Now, in the case of the driveway, we're doing 15%, or excuse me, 15 years. So what we're looking at is we're not using this table with mid-month. We're using we're using a different table there. I know we just have that one in there, but if you go back to chapter 14, there's a table in there that deals with the half year and the 15 years recovery period. So that's where that number comes into play as being a little bit different. Okay. All right. Okay. Any other questions? Again, if you want to pop your mic off and throw something out there, let me know. Or you can type it in the chat there down in the corner. Any other problems you want to look at? Any other scenarios there? All right. Okay, so nothing else that we have there. Again, if you want to type it in the chat, or again, you can do that. All right. Did that answer your question, Sean, with depreciation? If you're savvy at spreadsheets, you can whip them in there pretty good. Otherwise, remembering our forefathers with the IRS, you might have to use one of these in case there's some of you that are so young. This is a pencil. It has a little eraser on the other end and a little tip that you sharpen, and that's what you would use. And a piece of the stuff that they make out of trees. It's called paper. Okay. All right. So you might have to do it that way, and a calculator, which most of you have on your phone now, so I can't really say that that's outdated. But so you have to kind of do it that way. So, but yeah, if you're spreadsheet savvy, you can kind of whip that in there, and that's not a bad thing too. To if you have a new client that's coming in that you're taking over for, and they have rentals, and maybe they haven't even been depreciating, and you need to start doing it. Doing a spreadsheet, having that and sliding that in there with the file when the paper that's kept in the office or that you retain as records, it's not a bad idea to do it on a spreadsheet and have it printed out, or even if you do it on a legal pad, making sure that you keep it. So, okay. All right. Okay. All right, everybody. I've enjoyed the class with you. And again, as we're parting here, I thought it only appropriate that now that you have survived this class with me, that we have a little graduation ceremony. All right. So again, best of luck to all of you. I'm not going to do any type of, speech that you get at the graduation that, you have to sit back and listen to and all that stuff. But as we finish up the class here, everybody's been great. I hope you've learned things. I will be sending out to everybody a course critique that will go out with the recording today. You can bring that in to hand to Maria as far as how you thought the class was, what you thought of the instructor. That would be me. And any suggestions you'd have for future things on the class. So again, I enjoyed having everybody in the class. I look forward to seeing everybody around the offices and such. So
thank you.
You're welcome. You're welcome. All right. All right, everybody. Best of luck to you. So, okay. And again, best of luck to everybody as they start the classes.
Thank you, Tim.
Thanks.
Appreciate it.
Been enjoyable. Thanks.
Thank you so much.